All right, take it away.
It's October 9th, 2020, episode 100. I'm Kevin Muir. Patrick can't be with us, but we have the good fortune to have our friend Harris Kupperman filling in. This week, we are pleased to welcome back to the show Lyn Alden. Lyn's last interview was a huge hit, and we look forward to hearing what she has to say this time around. In This Week in Trading History, we go back to 1886 with the Guinness Beer Company's IPOing. The funny thing is, the Irish are still celebrating the launch. For the WTF Clip, Trump and Macaulay go big. And then we do our new segments of No Stupid Questions and Skin in the Game. And folks, we might just drink some beers along the way. So stick around. We got a great show. Lena, hop on.
Hello.
Hello. And Kuppy, welcome to the show, bud.
Hey, guys.
Thanks for filling in for Patrick.
He's still trying to sober up, I think.
Yeah. Kuppy had an epic Thursday night, and he's won't be joining us on the drinks, Lena.
No, but we will be drinking, though. This week, we're drinking Route 19 Brewing Company's Supernova New England IPA. It is a double dry hopped with Citra, Mosaic, and Eldorado, providing a huge citrus and tropical fruit character with a soft, smooth mouthfeel, leaving aromas of pineapple and grapefruit.
So, Lena, I have to say, comes from the East Coast, from the Maritimes.
Right.
And it was actually my daughter's boyfriend that arranged for this beer.
I see.
Yes, I see. So usually I'm a little hard on the beers. Maybe I'll be a little nice because this young man certainly knows the way into my heart.
Bonus points.
He's given me beers. You know what? He's my kind of kid.
Yeah.
Anyways, and you know what? I was a little worried when I heard them talking about fruit, but it actually isn't bad. But listen, we'll talk about more of that at the end of the show. Let me get through the disclaimer.
Yeah.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much Huddle may include jonesing for the jow. I'm obviously too many drinks into this. Jonesing for the Dow. The musk, and the soaring clear energy.
Musk.
Musk.
Tongue twister there.
Yeah, I'm not doing very well. Let's get on to the interview with Lyn. It's our pleasure to welcome back to the show Lyn Alden. Lyn, thanks for joining us.
Thanks for having me again.
Well, I was telling you before we were taping that you were our most popular show ever.
Well, I try. I think it was the charts, and it certainly wasn't my charisma.
I disagree. I also think that one of the things that many viewers were stunned by is the fact that you're just a fountain of knowledge. Your ability to go back and recall dates and put kind of the historical perspective on what's happening in the market is truly kind of unique. And that's one of the things that I think a lot of people were attracted to. So one of the things that you've done is that you've also done at this time for us is you brought us a little bit of a chart package, and you're starting off with the long-term debt cycle. Why don't you walk us through what you see here, what this means, and what you think it means going forward?
Yeah, so this has been one of my highest level themes over the past 2 years or so, and it's inspired from the work of Ray Dalio. And the key point there is that over the course of multiple short-term business cycles, so 5 to 10-year credit cycles, what generally happens is that you have companies, households kind of leverage up, but of course they eventually over leverage. They do some degree of malinvestment, and then either kind of something just deflates naturally, or you get an external shock, and so then you have a deleveraging event and a recession. But because the system that we're in for a while now, policymakers then rush in, they lower interest rates, they do fiscal spending, and they basically try to offset that. And so what happens is we see an increase in sovereign debt, and we see kind of that deleveraging cycle gets cut short, and so interest rates are kind of hit a lower low and a lower high. And debt levels, they deleverage partially, but they never deleverage back to where they started that cycle. And so then they start moving back up again. And so after you string together multiple of those cycles, you eventually get lower and lower interest rates and higher debt levels, both in the private sector and the sovereign debt. And that kind of comes to a head when interest rates hit the zero bound.
Right.
And so then everything kind of changes pretty markedly. And so what I have here is charts of the very long-term debt cycle. So a lot of my analysis focuses on debt as a percentage of GDP, and those are the common charts. But for these charts, I use debt as a percentage of broad money supply because they actually show it in an even cleaner way. So the blue line on these charts is debt as that's total debt. So it's U.S. federal debt and corporate debt and private debt, state debt, all the different debt types.
Can I
And
interrupt here 1 second, Lyn?
sure.
I struggle with where do I find that information. Can I ask, maybe this is one of your tricks of your trade that you don't want to give up, but where do you find that going back that long?
So different sources. So this is all part of a big data package I put together a couple months ago, and it took a while to put together. So basically, it all came. So the St. Louis Fed, for example, has information that goes back several decades. But
Yeah.
if you want to go back prior to World War II, it does get a little bit more complicated. So I used so Treasury Direct has federal debt levels going back pretty far. And
Right.
then I found old Federal Reserve documents that bring me back to the 1920s. And
And you type those in by hand?
yeah, I built Excel models out of it, so that I have it going forward. It was a lot of upfront work, but now I have it kind of continually. Yeah.
That's awesome. That's terrific. It's a great series because it is difficult to find. So I interrupted you. I'm sorry. Continue.
So this so it's all the different debt types, and basically when you hit the zero bound, then you're at the long-term debt cycle. So this chart, the blue lines are debt as a percentage of broad money supply, and uh, orange line in the first chart there is short-term interest rates. So kind of like magic, basically like the zero bounds were associated with the peaks of those long-term debt cycles. So the previous one was in the early 1930s, and the more recent one was 2008, 2009. And so we're still kind of working our way out from there. And so that kind of sets in my view, the really big stage for where we are in the cycle, and why these kind of past two recessions have been very different than, say, the past 50 years of recessions. It's a very different environment because we're at kind of the resolution of a long-term debt cycle here. And then the next chart, next to it, it shows a similar, the same kind of debt to M2 ratio. But then I also show some fiscal policy there. So I show federal deficits as a percent of GDP, and I show annual inflation. And so, one of the themes that makes these long-term debt cycles different than a normal business cycle is that, when debt gets to extraordinarily high levels like that, either as a percentage of M2 or as a percentage of GDP, usually currency devaluation is part of the variables that kind of deflate that bubble. So those debts generally aren't paid back nominally, but instead the denominator increases. So the amount of currency in the system goes up pretty dramatically.
Right. And so in the 40s there, we had multiple years of inflation that was running really high. Like it's been a while since I've looked at it and I've forgotten how much inflation we had during the wars.
Yeah, everybody associates the 1970s as the inflationary decade, and it was, but the 1940s were just as inflationary. And the main difference was that the 70s, that was kind of a shift in the global monetary system. So that was a transition from the Bretton Woods system to the petrodollar system, and it came with a kind of a currency devaluation, and we had pretty large deficits going on at the time. Whereas the 40s, had these, had major kind of money printing. It was like I described it last time I was on your show as wartime MMT essentially.
Right.
So you had very large fiscal deficits, and the Federal Reserve was buying a lot of the Treasury issuance and doing yield curve control. But that was combined with occasional supply shocks or other things like that, and so that's where you got that more inflationary environment, and it kind of came in bursts. So it was kind of like in the 1940s, you had three really big spikes of inflation rather than kind of a sustained inflation.
Interesting. Okay, so you've set the picture for the long-term debt cycle, and now what's this next chart? The 100 years of policy.
Yeah, so this is kind of focused on how policymakers kind of change their tools a little bit along that long-term debt cycle. So in an environment where you're not towards the end of a long-term debt cycle and interest rates are higher and debt is not super high, monetary policymakers have a lot of tools. So I refer to that as monetary dominance, meaning that the the money multiplier is pretty high. Interest rates are pretty high, so the price of money is pretty expensive. So their ability to kind of go in and manipulate interest rates gives them a pretty significant degree of flexibility for controlling inflation or providing stimulus. However, when the debt levels get very high and you run into the zero bound, monetary policy becomes a lot less effective. And so what we see is that even though they do asset purchase and stuff, it doesn't really do a ton, and instead it's the fiscal deficits that generally come in online at that point. So the left chart here shows that when the zero bound is reached, right? So that's the orange line hitting zero. That's the interest rates. The blue line is the monetary base as a percentage of GDP. So that's like the bank reserves, the currency in circulation. And so basically they are, for lack of a better word, printing money. However, by itself, that doesn't really get into the economy. That just kind of it's responding to a banking crisis. It's recapitalizing banks and things like that. And it's not until the fiscal authorities run very large deficits, either in the form of tax cuts or spending, that they tend to be able to reinflate from there. And so that's what we generally saw back in the 1930s and 1940s. And we've kind of been seeing ever since roughly 2008, where monetary policymakers kind of they use up a lot of their tools, and then it kind of becomes a matter of what are fiscal policymakers going to do.
Right. So I'm looking at this, and in the 30s, I guess I had forgotten how much of a deficit they were running even before we got into the wars. But I guess that was a function of the Depression, and those were kind of automatic fiscal stabilizers, or the lack of revenue from the taxes.
Yeah, so back then they didn't really have automatic stabilizers like we do today, because that was kind of before a lot of these entitlement programs and things like that. So first you had some spending from Hoover. He doesn't really get credit for that, but Hoover did spending, and then of course when FDR took over, they did the devaluation versus the gold peg, and then they continued to run pretty big deficits. So basically, for the first several years of the Great Depression, that was one of the only times in U.S. history where we had a decrease in broad money supply. So nominal M2 actually went down because you had bank failures, you had no FDIC insurance. So basically, just money was destroyed. But then starting in the a few years later, they devalued the gold peg, they recapitalized the banking system, and then so they started to get M2 going back up. And so that was a very deflationary environment. But then when they did the currency devaluation, it reflated that a bit. But the overall decade was not very inflationary because it was mostly, all that inflationary policy was just offsetting a very deflationary debt and demand destruction environment. And it wasn't until the 1940s that we saw the more inflationary environment.
So one of the questions that I have, Lyn, when I'm thinking about this is that it took a war for the government to actually spend enough and kind of really put the pedal to the metal, so to speak, on the fiscal side. Do you think that that the COVID is our generation's war, and do you think it's enough to continue with the fiscal policies?
So far it was. Like if you look at that chart, I mean, 2020 had a deficit so big that you have to go back to World War II to find a similar deficit. And so, in the 1930s, they were, what they were doing, what they thought were pretty big deficits, but they were small compared to what they would be up against in the 1940s. And so, they did pretty big spending, but it's interesting because even though it helped to some extent, the economy was still pretty stagnant. And when they had, we often think of the Depression as like one giant recession, but it wasn't like that. You had the really big shock in the early 1930s. That was kind of the worst part of it. But then as they progressed through the 1930s, they did public works projects, they did all sorts of things. They started stagnating again as they kind of pulled that back a little bit in the later 1930s. And then it wasn't until the 40s that they were kind of forced to ramp that back up. And so going forward, we have kind of the first year. So if you look at that, the 1940s, you had multiple large deficits in a row, whereas now we have one. So it actually is a really big kind of open question about what policymakers are going to do going forward.
Right. It's actually interesting you bring up the Depression and the kind of start and stops. There's this really great book that's a diary of a lawyer in Ohio, I believe, and he goes through it. And what I found fascinating about it is that it's kind of a play-by-play, and so many things remind me of the current environment. So often they were worried about hyperinflation. They were worried about spending too much. It was all the same concerns, and yet it just continued to stagnate and stagnate.
Yeah, that's pretty much what we're seeing now. We had the multi-trillion-dollar stimulus, but it's up against such a big kind of deflationary impact. And it's a challenge because, back in the 1930s, they eventually got what they were looking for in the 1940s. And of course, that was a really terrible time for most of the world. And anyone holding kind of treasuries or holding money in banks lost, about a third of their purchasing power. But basically, that was kind of the cost of building up the industrial production and kind of reflating nominal GDP. So going forward, I think now basically, in the 1940s, policymakers could point to the fact that it's a war. They don't really have a choice. They have to win the war. The pandemic is in many ways like a war. So it's kind of amazing to see, we have such a polarized political environment in the US, and yet, they came together and passed like a $2 to $3 trillion stimulus early this year very quickly. And that's kind of one of those things that can only be done when they can point to a really big external catalyst and say, we have to do it to offset that.
Right. One of the things that I've been thinking a lot about lately, Lyn, is the idea of spending just to fix a short-term demand problem is a lot different than investing. And one of the worries that I have is that a lot of this spending, yes, it's fiscal stimulus, but it will be, in essence, more inflationary because it'll be money wasted. Have you given any thought of that? And is there any way that you've come up with in terms of trying to differentiate between which countries are spending and in which countries are investing?
Well, I think so far it's mostly along the lines of spending more
Right.
than investing. And so, back in the 1940s, they roughly tripled industrial production. So basically, that was kind of a measure of how productive some of that spending was, because they basically, by the time they did all that spending, they ended up with a much larger productive base.
Right. Okay.
Whereas,
Because they were
right,
making factories to build planes, and there was
exactly,
and
yeah,
know how they were learning stuff to along the way.
yeah, and then even when the war ended, of course, they had a kind of a contraction from that, but they still kind of had a much higher base to work from.
Right.
And then they also, for example, did the GI Bill, where they trained a lot of people. They educated and trained them technically. So by the time that was all done, they had a much bigger industrial base and they had a more educated population. And just the whole kind of political scene was more unified than normal. It was kind of the classic like fourth turning, kind of society comes together and solves a big problem sort of thing.
Right.
So going forward, I think it's kind of country dependent. So some political systems are kind of inherently set up so they can do more fiscal, and other ones are not. So, Japan, for example, doesn't really have a lot of political polarization. It's easier for them to do fiscal spending, whereas the United States, we're kind of in the middle because we have a very kind of highly polarized politics, more than average. And Europe has their own set of problems because they're not as polarized internally. But when you look at the whole European Union, because they link their currencies together, they have an extra layer to go through for fiscal spending. So they kind of have the most challenges when it comes to fiscal spending.
Does this kind of setup on a political basis lead you to be more kind of sympathetic or be more attracted to Japan?
Well, I'm fairly bullish on Japanese equities. So since 2016 or so, I was pretty bearish on Europe and Japan equities relative to U.S. and emerging markets. Just because they had slow growth and there's a lot of things weren't really attractive about them, but they've had a period of underperformance, and so you have kind of a better valuation differential. And Japan handled the virus pretty well, so they haven't really been as heavily impacted. But then they're also doing fiscal spending, so
That's
on a
right.
comparative basis, I think Japanese equities are pretty attractive overall. And Japan has a positive current account. They have a positive net international investment position. So they have a pretty technological heavy culture, and economy. So they have, of course, the bad demographic trends, but they have other kind of things in their favor now. So I am, over the past kind of year or two, I have kind of increased my view towards Japan.
And I believe they're doing the highest stimulus as a percent of GDP out of all the majors.
Yeah, I think so. I know that for a while it was the U.S. and then Japan kind of ramped up a little bit.
Right. One of the things that I find interesting about this kind of last few months is how much what you're talking about and what I've been talking about in terms of a sovereign not being financially constrained has kind of been accepted by the investing community. It's whereas before when you said these things, you got told no, that doesn't make any sense. Now all of a sudden we're seeing people kind of waking up to this and realizing that there is no constraint. The real constraint is inflation. I've often wondered if Japan, who was ahead of the pack in terms of deflation and a balance sheet recession and stuff, whether they're going to be ahead of the pack on the way out of this as well, and whether that as people realize that they're what looks like is a high, debt to GDP ratio, which has stopped people from investing in them, is actually not as a big a deal as they think because of the fact that half of it is owned by the central bank. Like, do you see that maybe Japan might be kind of the litmus test, the poster child for the other side of this kind of solution?
I think it's possible, and there are a couple kind of data points, like you mentioned that the public opinion's turning on it. There has actually been Pew Research polls, from that showed 2 years ago. I think it was 55% of people polled said that they think the deficit was a problem. And then in 2019, that was back in 2018. So then 2019, the deficit got bigger, and it was only like something like 53% of people found it to be a problem. And then in 2020, the deficit blew out dramatically, and now like 47% of people viewed it as a problem. So the bigger the deficit got in the U.S., the less people considered it a problem, which is kind of funny. And so, I do think that opinion is shifting a little bit. It's certainly, it's been more influential on the Democrat Party, but then as you pointed out, Trump himself is a very MMT heavy president. So it's not cleanly along party lines, and you know, uh, one thing I kind of focus on it for Japan is that, for a while, people have been saying that, the whole world's going to be Japanified, right? So
Right.
everything's gonna go into this like prolonged deflationary environment. But one of my theses is that, Japan is in some ways unique because they have the largest net international investment position in the world in absolute terms, which means that they own more foreign assets than foreigners own of their assets.
Okay.
And even as a percentage of GDP terms, it's pretty high. So it's one of the highest. And so basically, they've had so many decades of trade surpluses and current account surpluses that they build up a huge kind of investment position, and they still have positive current accounts. So their currency has kind of a lot of kind of inherent strength to it. And so, I think Europe has similar characteristics. One thing that makes the United States different is that, because of the way the global reserve system is structured, we run very large deficits, trade deficits, and we have, the world's largest, debtor position. So we have the most deep negative international investment position. It's the worst by absolute standards, and it's one of the worst as a percentage of GDP. So we're a little bit more kind of susceptible to currency devaluation when we run very large deficits. So one of my theses is that I think this is going to become very popular, and I do think that currencies will devalue to some extent, but that'll have kind of positive results in some areas, but that the U.S. dollar could potentially devalue somewhat further than the other majors.
Okay, Lynn. So if I'm getting this right, you're thinking that we got a period of U.S. dollar weakness coming ahead. How do you see that playing out with the European market, which might not be able to handle a stronger euro?
So there's a couple facets to that. Back in 2018 or so, I was neutral to bullish on the dollar. I got neutral on it in early 2019, and it was the repo spike in late 2019 that I shifted dollar bearish. So it was early October. The dollar index was at like 99, and that was when I became more of a structural dollar bear. So we've had somewhat of a downward move, and so at the current time, because there's no stimulus at the moment, we're kind of in a counter trend rally.
Right.
So we've had kind of a stabilization and an uptrend in the dollar, which is not surprising. And so, I think as it'll partly, of course, depend on politics, election outcomes, all sorts of things like that. But kind of my base case, until I see otherwise, is that the U.S. is probably going to run some of the larger deficits, fiscal deficits, while also running uh, um, a trade deficit, right? So
Right.
we have a worsening trade deficit, and so that tends to be currency negative. And combined with the fact that if you look over the past roughly 50 years, if you look at the long-term dollar chart, there have been three really strong periods for the dollar. And so one was in the mid 1980s, the next one was in the late 90s and into the early 2000s, and the third one has been ever since early 2015. We've been in a strong dollar environment. And so we've had 10 years of, just tons of money's been pouring into the US. We have, high stock valuations. We have high currency strength at a time when we shifted from being one of the tightest central banks to being in some ways one of the loosest. So our interest rates are not the lowest, of course, but we're also doing in some cases more rapid QE. So when you combine that kind of loose fiscal policy, loose monetary policy, and then also specifically that current account deficit, that makes the dollar somewhat more volatile and more likely to fall if you get that continued stimulus. Now for Europe, they don't want the euro to strengthen too much, but at the same time, if you were to get a notably weaker dollar, it would benefit emerging markets, which indirectly benefits Europe as well, due to being a trading partner. So it's kind of that sort of musical chairs outcome where Europe doesn't want the euro to strengthen too much against the dollar. But then in many ways, a weaker dollar kind of benefits multiple countries, including emerging markets, the United States, and then indirectly a little bit even Europe.
Yeah, I completely agree, Lynn. I think that the whole world needs a weaker U.S. dollar. They need more U.S. dollars in the system. And for those that are expecting the U.S. dollar to go up, I think that you're going to be battling every single central bank and government authority in the world because, let's face it, if we get a strong U.S. dollar, it's probably going to be a disaster on the financial situation.
Yeah, we actually saw that back in March and April when we had that kind of that spike in the dollar. So the
Right.
dollar index got up to like 103. And so the problem is everybody always points to the fact that there's so much dollar-denominated debt in the world, right? So Europe and Japan and emerging markets have all this dollar-denominated debt. But that's depending on what source you look at. Like the Bank for International Settlement says that's about 13 trillion. But it's also the fact that because we have a negative net international investment position, the foreign sector owns about $40 trillion worth of U.S. assets. So
Right.
if there's an acute dollar shortage, they can sell U.S. assets to get dollars, and that's basically what they did back in March and April. They started selling treasuries and selling some other kind of liquid U.S. assets, and that basically forced the Fed to step in, and they had to buy $1 trillion worth of treasuries in 3 weeks, and they had to open swap lines and do all sorts of stuff because a kind of a rapidly disorderly spike in the dollar inherently results in U.S. assets being sold in order to get dollars.
The other thing that often people that use those kind of scare tactics about the amount of U.S. dollar debt outstanding, they don't put that as a percentage GDP. And yes, it's going up and it's always going up. The reality is that the global economy is growing, so therefore it should always be growing.
Yeah. One of the analysis I did, because so one of my kind of focuses over the past year was really kind of tackling that problem. And so I kind of came out with that moderate view, which is I was highlighting it as a problem, but also pointing out that the other side of the ledger, which was all those assets. And so I put together a chart, for example, that showed. Uh, I focused on the emerging markets because they were the most vulnerable, but I picked like 12 emerging markets and I showed their dollar denominated debt as a percentage of GDP relative to their total FX reserves as a percentage of GDP. And so it showed, for example, why Argentina and Turkey are far more vulnerable than, say,
Right.
China or India or Taiwan and places like that. And of course, compared to Europe and Japan, which are fine. So it, on one hand, you have had debt go up faster than GDP and compared to, say, U.S. money supply or other metrics. So for the past kind of 2 decades, it has been kind of a bottleneck and a problem, both not just in absolute terms, but also as a percentage of things. But
Okay.
kind of the response to that is if it becomes so much of a problem, where they have to sell foreign assets to get dollars, like we saw back in first we saw it a little bit during the Great Financial Crisis, then we saw it again in 2016, and then we saw it in a big deal in March and April of 2020. So it kind of has the natural policy response pushes back against that, and so basically it's all about scarcity in something that's not inherently scarce. Like if that scarcity becomes an acute problem, they make more of it. They do
Right.
swap lines, they can do all sorts of things, and they even have other tools that they could use if they needed something even bigger.
What would be those tools?
Well, for example, the swap lines were ended up being sufficient this time, but I mean they can also, they can outright buy foreign bonds. They could buy gold, for example. They have kind of more permanent things they could do to get dollars out there if they had to. They have kind of those like nuclear options, but they're kind of political choices more so than just monetary choices.
I can't remember. Is the Federal Reserve allowed to buy gold? I think they are, right?
Yes.
There would be
Yeah.
no change in rules, right?
No, yeah, they're allowed to buy gold.
Right. And that's always, that's the Jim Rickards, revalue gold to 5,000 and everything, resets the whole system kind of argument.
Yeah, and so that's why I often say that monetary policy is mostly out of options, but they have some nuclear options. So kind of in conventional policy, it's mostly on the fiscal side. Monetary authorities still technically have some options on the table, but they're more about political choices. And so one thing I pointed out before, as an example, was the U.S. is one of the only major countries that doesn't really have foreign exchange reserves, right? So we have our gold reserves ostensibly, but we don't hold foreign exchange reserves because we're the global reserve currency, right? So we're the
Right.
axiom, we don't hold that. But if they ever wanted to, they could. They could, for example, buy foreign currency and then invest in those sovereign bonds and bring up their FX reserves to 5% of GDP or 10% of GDP in line with other developed countries. And so that'd be a way of getting dollars permanently out there in the global system if they wanted to. I'm not saying they will. It's just more like if you have an extreme environment and you have kind of a scarcity and you have a kind of a, the scarce asset, they can basically just make more of it. They can make more dollars if they have to.
Do you know, Lyn, that's fascinating. I've never thought about these things as being monetary solutions. Like I never thought that buying gold as a monetary kind of option, and it doesn't seem to ever be, thrown out there as an actual kind of solution to the problem. But you're right; it solves a lot of the problem that the monetarists are trying to accomplish.
Yeah, I think it's, and I view it as like I said before, kind of a backdoor option or like a nuclear option. Like if fiscal gridlock goes on forever, technically those are kind of like accords they could do, kind of like we had the Plaza Accord. There are kind of those backdoor policies that can devalue a currency, but they haven't really been my base case. It's more just like
I completely get it. You're not out there predicting it, but you are highlighting that this can happen. I always say that one of the things that I find most interesting is all these people that are assuming that we're going to get a deflationary implosion, and like for example, the U.S. dollar is going to go up, stocks are going to go down. I always laugh and say, how many countries do you know that have collapsed because of deflation? I can't name any, but I sure know a lot of countries that have collapsed because of inflation. Now, you're a real student of history. Do you know any countries that have collapsed because of deflation?
Yeah, the funny thing is you asked me this on our previous interview, and so the answer we came up with was Russia, in the sense that they did default.
Oh, that's right. We did talk about this. I should have remembered. You're absolutely right. They did they did default on their own currency, but otherwise, and that was kind of a very unique political thing. And but otherwise, there's really been no cases of that. And I guess that's why so many people got hurt so bad on Russia, because no one was expecting them to do that. Everyone always assumed that they would just inflate their way out.
Exactly. Yep.
Yeah. Anyway, so that is fascinating stuff. The idea of buying gold and buying other currencies just before we leave this, is the Fed allowed to go out and buy other currencies? Like that is also allowed in terms of their charter?
I'm not sure. I know that they can buy gold. I haven't gone into the paperwork to see if they can buy foreign bonds, but if it's something that could easily be amended if they ever had to.
Right. Okay, so let's go on to the next chart you brought. So we're going to talk about some stocks and what's happening in the stock market. And you brought up the first one we're looking at is Apple, and you have something called the FAST graph. Why don't you tell us what the FAST stands for?
So that's Fundamental Analyzer Software Tool. So it's not a graph I develop; it's a tool that I use. So it's like the company's called Fast Graphs, and so the point of these last two slides is just kind of to show what's happening in certain sectors. So I'm going to highlight two stocks here, but it's not really about the stocks themselves. It's more about kind of a general theme. And so on this chart, this is Apple. And so basically what it does is it compares the stock price compared to the fundamentals. So the black line is the stock price. And the blue line represents, if you look at the past 20 years, what their average price to earnings ratio was, and if you were to apply that price to earnings ratio to their current earnings, what would the stock price be? And then the orange line is a more generous measure that takes their growth rate into account when applying kind of a historic price to earnings ratio. And so what this shows is that over the past several years, their fundamentals haven't changed that much. They've continued their steady upward trend. They're doing pretty good. But their stock price went absolutely parabolic in 2020. And so it's not that their earnings went parabolic. It's not that their fundamental business went parabolic. It's really that their valuation went parabolic. So now it's at a point where the price to earnings ratio is well into the 30s at a time when their growth rate is it's not bad, but it's not great either. And a lot of that growth is from share buybacks and other things like that, rather than top line growth. And so one of my arguments is that Apple's a fine company, and it's historically been a pretty low risk company, but at these extreme valuations, there's more kind of risk in that company. And it's not really about Apple in particular. Like I can show multiple tech stocks that have kind of had this parabolic price rise compared to flattish fundamentals, or
Right.
moderately good fundamentals. And there's all sorts of arguments, like we can say because interest rates are so low, it makes valuation to go high, which is true to an extent, but we haven't really seen the same thing play out in, say, Japanese equities or European equities, and so even some of the higher quality ones there. So there's certainly kind of a limit somewhere between for how much we can pay on a sustained basis for earnings, and have that kind of not have a lot of downside risk. So I've been trimming some of my tech names this summer. So I've had like Adobe, I've had Nvidia, I had Apple earlier. I've had kind of these names in my portfolio, but I've been trimming them a little bit just because they're some of them are at kind of nosebleed valuations.
Right. So now let's go to the next chart, which is almost the opposite, right?
Yeah, so there are a couple of industries there where, of course, their fundamentals have not done as well, but they're priced it even worse. So Apple was a case where their fundamentals went moderately upward, nothing special, but their stock price and their valuation went parabolic. This is a case where this company's enterprise products partner. So they're a big midstream company. They transport not just it's actually mostly not oil. It's mostly natural gas liquids, petrochemicals, all the things you make plastic from, natural gas, kind of a diverse set of things. And so they're historically one of the more conservatively managed businesses in the sector. So every time the midstream sector blows up, they've historically not blown up. And that's because they have among the lowest debt levels in the industry, and they're heavily owned by insiders. So they've had 21 years of consecutive distribution growth. And what we've seen generally is that, whenever you have kind of a big oil price decline, they mostly make their money from transporting it, so they're only kind of moderately impacted, because they have kind of reduced volumes and stuff like that.
Right.
And so, you know, they're kind of facing a headwind here, but it's they faced headwinds in the past, and their valuation just completely collapsed, right? So now they're off. They have more than a 10% yield. It's well covered by cash flows. Their cash flow yield is something like 17%. And so they're just extraordinarily unusually cheap. You have to go back to the, 2008 to find a time when they were similarly cheap. 2009, that kind of period. And so, I've seen this in a couple different sectors where if there's a lot of junk out there, but if you look at the kind of the highest quality names in those kind of bombed out, like super low sentiment sectors,
Right.
some of them are actually pretty interesting for
Oh,
people that are kind of long term patient.
what are some of the other sectors that investors should be looking at?
Well, tobacco is actually kind of an interesting example because, over the past 20, 30 years, tobacco was actually one of the best performing industries. And so even though smoking is fortunately on the decline in many countries, especially the US, the valuations were so cheap and the returns on invested capital were so high that through a combination of high dividends, buybacks, and price increases, many tobacco companies beat the market over the long term.
Right.
And so, we've kind of had a similar situation in the past couple of years where valuations on tobacco companies came down pretty rapidly in like a 2 to 3 year period, but many of them are doing fine fundamentally. So that's kind of an area that I've been looking at a little bit. I'm also seeing, the healthcare sector is not bombed out, but it doesn't seem to have a lot of excess there. There's, this political risk around it, but there are some kind of international names or kind of well diversified names that don't really have a lot of existential risk from, healthcare reform and things like that. So, I think there are sectors that have different degrees of risk associated with them, but that overall are not that bad looking.
Okay, that's some great stuff. Now, changing topics a little, we're going to jump into something. You're being a millennial and all, you're a little more partial to the Bitcoin than I am. And one of the things I've been seeing you tweeting about is the fact that you were talking about Bitcoin correlations and that you view this as kind of a more serious asset class than I do. So why don't you walk me through your thinking and tell me where I'm wrong?
Sure. Actually, I'd be curious to hear your opinion too. But so, I first covered Bitcoin in writing back in the autumn of 2017. And so that was, of course, when I had that huge parabolic rise. So I got tons of emails like asking me to write about it. And so eventually I put out a long form research piece on it. And my thesis at the time was that you can value it as a medium of exchange or as a store of value. And I kind of used a couple different frameworks to value it. And I concluded that it was most likely overvalued. And that with so much kind of speculative bullishness on it, I was pretty concerned about it. So I took no position. I said, if you want to have a small position to play with it, have at it. But I was kind of, I was concerned about the intermediate term. But we've had, since then, it quickly spiked to like 20,000, then it collapsed, and then it's been in this choppy kind of 2 to 3 year consolidation. But in April of this year, I turned bullish on it. And that's because, we've had kind of 2 to 3 years more of ecosystem development. So there's more kind of surrounding infrastructure around the protocol.
Right.
And so we have more access points. We have more use cases for it in some ways. We have a broader investor base. And we don't have kind of high flying sentiment like we had back then. So there's more skepticism, there's more caution. And so I've been, given the macro backdrop, I've been pretty bullish on Bitcoin. And then as an added catalyst, if you look at, Bitcoin since inception, every 4 years, the supply rate of new Bitcoin generation gets cut in half.
Right.
And so that's one of those things where the media loves it because they write about it and it's like as though it's a big event. And then, of course, nothing happens. But historically, almost all of Bitcoin's price gains occur in the 2 years after halving. Whereas, the 2 years prior to halving is when it's usually in those big consolidation periods. So it's kind of a culmination of multiple factors together, which is that I think the network effect of the protocol is doing pretty well. And then you have this big kind of macro backdrop of large deficits, zero interest rates perpetually, and things like that. And then when you add that to the timing of the halving catalyst.
I'll tell you one thing that I've noticed is that when you go look at the large ETFs that are buying Bitcoin, and I guess the biggest is that GBTC, I think they're hoovering up almost all of the new Bitcoins that are being mined. And that's just them. And there's other
Yes.
Bitcoin things out there. So, I might, from a fundamental perspective, hate it and think it's, I always say it's a solution in search of a problem. I at my trader hat, I put it on and say it looks a lot like one of these low float stocks that people get short, and there's just not enough to go around. And sorry, go ahead.
I was gonna say that's pretty much what happens because there are a lot of data analytics that have gotten better over the past several years too when it relates to Bitcoin. And for example, there are lots of charts that show the percentage of Bitcoin supply that has not moved in a past year or the past 2 years.
Right.
And so, between the halving cycles, that tends to start rising during that consolidation phase. And so we're at a point now where something like 60% of Bitcoin supply has not moved at all in the past year. So when you have that kind of, a lot of people are just holding their coins, and then you have kind of demand for it keeps trickling in, and then when you have kind of reduction in the number of bitcoins that are created every 10 minutes because of that halving, that pretty much what that does is that potentially, as long as demand remains intact, which is of course always the big question, that can potentially kind of come into that kind of low float environment and put upward pressure on the price. And then if it breaks out, then you get the momentum traders on board and you get kind of the FOMO buyers.
I always tell that the younger people that are trying to convince me to buy it, that the last thing you want is me to buy it, because that'll be the top. So now, are you viewing it? I see you're doing some analysis as correlations versus other asset classes. Are you viewing this much like a digital gold, like just a real asset that's uncorrelated to the other financial assets that might be a good addition to the portfolio?
I view it similar as digital gold, yeah. So it's, of course, it's a smaller market cap, it's more volatile, and so it has the kind of the capacity to take more market share if the the network effect grows. But yeah, so this is because we're in a very fiscal heavy environment and there's so much debt in the system. There's a lot of things that are correlated. So it's kind of like equities, gold, silver, and Bitcoin are all somewhat tightly correlated this year because if we get, say, more stimulus, if you get rising inflation expectations, if you get falling real yields, that can be good for these scarce assets. Um, However, if they kind of pull back on fiscal stimulus, you get a more disinflationary environment, at least temporarily, and of course that can put downward pressure on equities. It can result in rising real yields, so that can put downward pressure on precious metals, because of course gold has a very long-term relationship with real yields, and then that can of course bleed over into Bitcoin because Bitcoin is a pretty volatile asset, so it's kind of it's tied to liquidity.
Right. So you mentioned real yields, and one of the things that's happened is, yes, real yields have been going down, but nominal yields have gotten just sleepy over the last little while, almost to the point where I was joking and saying that if this was a patient, the pulse, like one of those electrocardiograms, you'd have to check and if he should be sent to the morgue. Because I've looked at the bond market, and it's just being straight across. It doesn't feel like some days it's even open. And in that, one of the things that's happened is actually the MOVE index, which is the VIX for the fixed income market, hit an all-time low. I was wondering what your thoughts are on bond volatility and what you think the ramifications are for the global economy.
Well, yeah, it's interesting because it's such a big macro environment because you had such a huge deflationary economic shock from the pandemic and the shutdowns and the debt, and then responding to that, you had this multi-trillion-dollar stimulus injection. So of course we had volatile equities, we had volatile precious metals, we had volatile Bitcoin earlier in the year, but whereas Treasuries. They had kind of a different risk, different profile. So, back in March and April, what happened was, of course, yields kind of were front running the equity market. So when the pandemic started to be a big problem, nominal treasuries, the yields sold off really sharply. So you had a really big kind of bull move in bonds. But what was interesting was that if you look at kind of mid March, it got to the point where the liquidity shock got so bad. So actually, what we talked about earlier, which was that the dollar spiked, and so the foreign sector had to start selling treasuries to get dollars, and so then we had we also had like risk parity funds sell treasuries, and it just kind of like the whole treasury market became highly liquid, and so the Federal Reserve had to step in and start buying them because yields kind of after they had collapsed, yields started quickly spiking, and so on their own you'd think that such a deflationary shock would just be lower and lower yields. But instead, after that kind of rational move lower in yields, you had that huge spike. They pretty much doubled from a very low base very quickly. And so the Federal Reserve stepped in and they bought $3 trillion worth of treasuries in 3 weeks. I mean, $1 trillion of treasuries in 3 weeks. So it was something like, three to 400 billion of treasuries per week for that kind of 3 week period. And
It was a crazy period. I remember
yeah,
getting the list of all the QSIPs they were buying. They would send this Excel spreadsheet, and it was just like 300 million of this, 400 million of this. It was madness.
Yeah, it was huge, and that hammered down that yield spike. So that kind of pushed it back down, And then so they've been slowly tapering their purchases, right? Because you got out of that big kind of deflationary shock, but they're still buying something like 80 billion in treasuries a month. And we're seeing kind of similar things elsewhere where other central banks are taking a pretty big chunk of their supply of sovereign bonds off the market pretty regularly. And so, I've been kind of watching that because, they've been tapering their purchases. We started to see a little bit of a messier bond auction, but nothing
Yep.
too bad.
Right.
And so, it's uh, the way I'm viewing it is essentially it's kind of a soft yield curve control in the sense that we have Japan and Australia doing some degree of kind of minor formal yield curve control, but other central banks, even though they're not doing formal yield curve control, they're still they're kind of hovering over the sovereign bond market like a concerned mother, right? They're watching it, and anytime that if auctions aren't great, they always have this capability to step in and just buy more. And so, and even Powell, I mean, every time he does a press conference, he says we need more fiscal. We can
Right.
support more fiscal. They're telegraphing to the market that they're willing to step in and keep that market, the volatility low, and just yields kind of smooth.
Right. And so if they do that, what do you like? How do you see it? What do you think that's going to happen to the rest of the economy if every central bank is out there kind of soft, as you say, the soft yield curve control? How do the imbalances fix themselves?
Well, I mean, that volatility shows up more in the FX market. So you have kind of more volatility between currency pairs, essentially. If you have, uh, central banks controlling the yields. So, for example, back to the long-term debt cycle, back in the 1940s, when the Fed did formal yield curve control, they held treasury yields below the prevailing inflation rate, and so they have the capability to do that because they have, you know, basically an unlimited balance sheet. So their biggest kind of concerns there are inflation and currency devaluation. So they can control yields, but if they do that, they lose control of kind of the value of that currency to some extent. So it's kind of that trade-off. And so the reason they did it back then is because sovereign debt level was so high that they had to take a percentage of that kind of supply off the market. And so that's what we've seen roughly since the repo spike, where if they want to control the price of money and if they want to keep the price of money pretty low, they have to take a chunk of that kind of sovereign bond issues off the market. And so that you know if they combine that with large fiscal stimulus, that's where you kind of get that somewhat more inflationary impulse, and kind of a period of partial currency devaluation that we normally see kind of in this period of coming off of a long-term debt cycle.
It could be the old eras of the foreign exchange getting exciting might be returning soon enough.
Yeah, I mean, I think it's possible. I mean, are you covering that at all?
Yeah, I completely agree. I think that we're going to see that these imbalances, if the governments go and step in and keep the volatility in the bond market like at zero, then the imbalances have to figure out a way to kind of fix themselves. And I think that it's going to end up with probably most likely a move down in the dollar. And it could catch a lot of people off guard and be much more violent than we ever remember. One of the things that I think is interesting is the fact that we've thought that these markets have been so tame and easy to trade. But, if we think back to the old days, there used to be a lot more volatility in macro. And as you kind of point out so rightly, is that the macro story has actually become much more unstable, yet the prices are actually as quiet as they've ever been.
Yeah, and it's just there's so much intervention,
Yeah,
and so a lot of people complain about it, but instead it's just you can use it to your advantage and figure out you can kind of look at a situation and say, if this happens, what do policymakers pretty much have to do? So,
right.
for example, we saw in March they cannot let the treasury market become illiquid. It just that, like we talked before, they never let a deflationary collapse happen, right? If they just do nothing and the whole treasury market becomes illiquid and they just shrug and say, have at it, that's where you get that kind of deflationary collapse outcome. But of course, as soon as that became a liquid, they were in there in a matter of days, and the reading through the meeting minutes of the Fed was interesting because they heavily cited how big of a problem that was, and that they described it themselves as extraordinarily rapid treasury purchases, because of how liquid it was.
Yeah. One of the things that I think in terms of that period was that the Federal Reserve was watching the stock market, but it was only once the treasury market went no bid that they really got nervous about it. And that's when they really jumped into action. Because let's face it, the equity market is big, but it's nothing compared to the bond market.
Exactly, and I think a similar thing happened back in late 2018 when we had the famous Powell said everything's on autopilot and we're going to keep raising rates and doing QT, and then the market threw a fit, and we had that big correction in Q4 2018. So I heard a lot of people saying that they were freaking out because the stock market was falling, but if you look at I'm sure you're aware of it, the junk bond market, there's something like no issues in like 6 weeks.
Right.
So credit totally dried up, and that I think that spooked Powell more than the S&P 500 selling off, because that's a kind of a more fundamental problem.
That's right. Well, Lyn, we'll let you go. For those who want to learn more about your work, and I can't recommend your work more highly. I am a fully paid up subscriber and extremely happy. Why don't you tell people where they can find you and how they can sign up?
So I'm at lynalden.com. I have a free newsletter. I have free articles, and I also have kind of a low-cost research service. And I'm also on Twitter at Lyn Alden Contact.
Well, thank you so much for your time. We look forward to having you back on some show in the new year.
Yeah, thanks for having me. I really appreciate it.
Take care. Okay, Kuppy, it's time for us to do talking charts.
And, all right, let's do this.
I have a feeling that you're not much of a technician either, are you? Do you practice the dark art?
No, it's all made up. They always look. No, these guys always look at the chart like a month after. You're like, see, I told you it was a cup and handler. I told you it was like a bouncing trapezoid, whatever. Like, it's all made up. You draw your lines and you look smart.
Yeah, and I always say, they always tell me if it goes up, you should buy it, and if it goes down, you should sell it.
It's kind of the stupidest logic ever. I mean, like buy high, sell low. That just sounds dumb.
Yeah. Okay, so what we did was I've made up some patterns, and I know Patrick he's an actual chartered market technician, and I'm anything but. But we're going to pick some stocks here. We're going to talk a little bit about the stocks, what we think about them, but then afterwards, I'm going to give you what I think these formations should be called. So the first stock is GameStop, or GameStore. What is this? GME.
GameStop.
You know the store. GameStop. That's right. So this thing took off this week and actually had a great day. I think this might be part of the reasons that you were a little hungover today, is it not?
Yeah. When the press release came out, I bought a ton of it, and I didn't get the exact top, but I got a good exit on it. So yeah, no, it was pretty good.
So why don't you tell us the story? What happened with this? Because even though it's talking charts, you and I are going to talk a little fundamentals, what we think's happening, and then I'll give you my formation.
Okay, yeah, I have a formation too. No, what's happening here is you have the mother of all short squeezes. There's more shares short than in the float. A bunch of the float is owned by ETFs. The borrow rate spiked. I mean, it's just wound up short suicide. And they issued a press release that doesn't really say much of anything, quite honestly. But it brought a lot of volume in. And I saw the press release cross the wire. I'm all about these event-driven things. So this thing's on my screen because of the short interest. So anything at all could just hit it into hyperdrive. If he scares one of the shorts and he starts covering the next one, it kind of just like ricochets through. So it gapped up limit, and I bought the as soon as it reopened, I guess. And I just bought a bunch of it, and I got filled real nice at about 11.25, and I just wrote it up because I just knew it would just keep squeezing once it started squeezing. And on my exit, the vol was so high, I wrote some puts because I just don't see it coming back down. But it's kind of this, yeah.
That's a shock. That's a shock, Kuppy, that you're writing some puts. That's a shock. I went out with a good, a big ex-broker that's retired now to a Caribbean island, and he loves you, and he actually was telling me, he says, I like that Kuppy. I like the fact that he's writing all these puts. I'm doing that too. And he loved this strategy. He thought it was a great strategy.
I mean, look, if you're going to get paid 200 vols on 1 week paper, why wouldn't you? I mean, I'm not taking any real event risk. I'm not taking earnings risk. At 200 vols, I mean, if it goes against me, I can always roll down or roll out a month if I have to. But I mean, this isn't like you're getting paid like a biotech, which could gap down and, the drug doesn't work and it's worthless. This isn't really going to gap down, but it's paying like this gap down risk because the shorts are so wound up. So anyway,
Right.
I mean, I think it's a great way to play something like this.
Okay, so now here I'm going to give you my technical. This is now official. This is the Kevin Muir technical formation. This is the erect rhino. That's the erect rhino formation. I don't know if you're going to find that in any chartered technician's handbook, but I think it's a good formation.
See, I would call it the short seller suicide.
Oh, that's good too. I like that.
Suicide by short selling.
Yeah, that's it. Suicide by short selling. I like that. Okay, let's go on to the next one, which is Exxon. And now this thing is just looking like death, but maybe, just maybe, we've made this a double bottom. I don't know if that's really what it is. I'm going to give you a different name, but I was wondering what you think about energy here, and specifically if you have any opinions about Exxon.
So I'm pretty bullish energy. I mean, the names are just washed out of sellers at this point, and I think a year from today, energy prices are higher, not lower. Exxon itself, I don't know. I don't follow it.
Yeah, it's too big. There's not nearly enough short for you. I do believe that it has over a 10% yield. Well, anyways, I look at this, and to me, that looks like the smelly rooster formation.
Why is this a smelly rooster?
I don't know.
It
just seemed like it was kind of a rooster. I don't know. I just trying to come up with some technical formations. There you go. Let's go on to the next one, which is the bond market. And we're charting 10-year yields. And it's gotten quiet. And it's just recently we've had, some people are getting all wound up about the decline in the bond market. And I say, have you guys looked at a chart? Like, this has barely moved. But no doubt about it, it does look like the yield is rising and causing some people to be worried about the bond market. But I was wondering what your opinion is about the bond market, and do you think that there is a technical formation that you could describe to this?
The bond market is a rigged market. The bond market's going to be wherever J-Pow wants it to be. So I don't even know what sort of analysis you can do on the bond market. Formation? Oh, God, I have no idea. That just looks like zero realized vol. Is that a technical formation?
I don't know, but I call this the sneaky tortoise. And I do think that it's sneaking up and that it could surprise people. It's kind of like the tortoise and the hare. That you'll find that the tortoise will actually win and that yields will head higher. Okay, here's the U.S. dollar. It's a lot of people earlier in the week got excited about the dollar when Trump tweeted that he had instructed his representatives to stop negotiating in terms of a fiscal stimulus. They all rushed out and tried to buy U.S. dollars, and that lasted for all about 10 minutes before the selling came back. What do you think of the U.S. dollar, and do you have a formation name for this?
U.S. dollar, I don't know. I think all currencies are kind of pegged to each other, and it's all just range bound. I don't know. I don't have a big currency view.
You're not a currency trader. That's true. I barely heard you, apart from winning the occasional stake bet from our good friend Patrick Ceresna. I've not heard you have much of a currency view. I like to call this the lethargic walrus. To me, I think it's headed lower, and that this is just kind of one of those formations that's just a little lethargic, but will roll over and go into the ocean like he does. Like when they're out sunning on themselves on the rock, and then they just kind of roll into the ocean. That's how I view this. Now, the final one, this is my favorite. I don't know if you follow this PPSI.
No, I don't. What is this?
Actually, this does look like one of your stocks. I have no idea. It was one of these names that there was some news kind of midweek. All the kind of the kind of fast time at Richmond High traders, the young folks, they all got into this.
300 million shares traded, and there's 3 million in the float?
Yeah. It was just stupid, right? Like, it's just crazy. It was a huge short squeeze. This kind of went from, what is it? It was $2. It opened at $3. It went all up, way up to 10 before coming back down. I will tell you, this is my final formation for this Talking Chart segment. This is the bite down on the pillow pop. I don't know how official that is, but I am calling it now. The bite down on the pillow pop. So there we go. That's this week in Talking Charts. And now we go on to this week in trading history. So we're going to talk a little bit about the Guinness IPO. And I don't know about you, but I've had a few Guinness in my day. How about you, Kuppy?
Oh, I've had my fair share. I actually went on a Guinness diet once. Guinness kind of filling, and I put on some pounds in college, and I'd read about this. But all you're allowed to do is the only thing you can consume is Guinness. So you have like one for breakfast, you have like two for lunch, but you haven't eaten anything all day. So you've put on about like 400 calories, and you feel full. Then you get hungover, you get drunk, and you have like two more for dinner. I mean, you literally do lose like 20 pounds in a week. It's a great diet, and I never once felt hungry.
That is awesome. The Guinness diet. So listen, I'm going to go do, Kuppy, we actually hadn't rehearsed this and I didn't know about the Guinness diet, but that is so perfect. And that is so Kuppy. So let me,
you can't have more than like 3 or 4 of these in a sitting. I mean, you just feel full.
Yeah, no, they are definitely a meal in themselves. I've always said that. Okay. So let me go through this because it's actually a great story. Okay. So it's no surprise that we at the Market Huddle love a good stout. So we thought we'd take this time to celebrate our 100th episode with a convergence of our two favorite things, the market and beer. So way back when, in 1886, just over 134 years ago, the Guinness Brewery went public on the London Stock Exchange. For some context of what the world was like then, at that time, Nikola Tesla founded Tesla Electric Light Company. John Pemberton began to advertise Coca-Cola. The city of Vancouver incorporated, and a quart of milk cost $6. Now, in Vancouver, it came in a bag. The story begins way back with Arthur Guinness, which I'm pretty sure he was Obi-Wan in the first Star Wars, who founded the St. James Gate Brewery in 1759 in Dublin, Ireland. Arthur leased the land at £45 per year for 9,000 years. He was an ambitious fella, and grew the brewery to the largest in Ireland by 1838 and by the largest in the world by 1886. By then, they had an annual output of 1.2 million barrels of beer. They soon bought all of the surrounding streets and neighborhoods, using it to house the employees. Even today, it's the largest producer of stout in the world. For the first 10 years of the company's existence, Arthur tripled his business. They began exporting beer and adopted steam power early to take advantage of the capacity to reach foreign buyers. By 1886, the business was worth £1 million, around 130 million pounds today, and they grew their property footprint from 1 acre to 64. At the time, the hot financial innovation wasn't a SPAC, but in fact a brand new British form of corporate financing, the Limited Liability Corporation, or LLC. Capital within these types of companies had doubled over the decade and represented $1.1 billion of the investment. Capitalizing on the opportunity, Sir Edward Guinness enlisted the Barings Brother Bank, choosing them over the Rothschilds, to underwrite a public offering of the company's shares in a process that is very similar to today's IPO. When Barings released the share capital prospectus, the offering was around 600,000 shares, 1/3 of which were reserved for Edward Cecil Guinness, Arthur's grandson, who would become the chairman of the new corporation. However, when the prospectus for Guinness IPO was distributed to investors, those who even bothered to review the financial statements were not overwhelmingly impressed. The Economist wrote, and now I'm going to actually interrupt here for a second. When I was reading this, Kuppy, I was like, that's got to be wrong. Like The Economist? Like this is in 1886. Did you have any idea that The Economist is that old?
No. Did they even have magazines back then?
I don't know, but all I could think about was I got to start getting the Economist covers to see if there was any like big turning points that were basically in the 1800s because of an Economist cover.
I mean, if you were trading in the 1800s, how'd you know to take the other side of stuff? I mean,
I don't know.
they must have had the Economist.
I guess you're right. I was just shocked. I had no idea the Economist was that old. But anyways,
their first issue was 1843.
There we go, Lena, hopping in 1843. Like that's crazy. Like that's I had no idea. I like this. You know what? If you take one thing away from this story, it's that the Economist is that old. Anyways, back to what they wrote in 1886. Take the average of, say, 10 years, calculate the present market value of the 6 millions of capital asked for, and the calculation works out to 8.5 million pounds is being paid for a concern whose profits during the past decade have not averaged more than 380,000 per annum. Regardless of whatever the Economist says, because it's, you know what, let's face it, the Economist was a rag even back then. When the news hit that Guinness was going to IPO at Barings, there was a mayhem in the streets, a classic mania. The Daily News wrote, nothing within the memory of a living man has been quite like it. On Saturday morning, Barings Place was literally besieged. A special police unit was called in to control the crowd, but speculators became so manic that they were literally threw themselves at the investment opportunity by tying their subscription forms to rocks and hurling them through the bank's windows in a desperate attempt to purchase shares. Take my order. It's on this rock that I just threw through your window. Some contemporary sources estimated that Guinness shares were 30 times oversubscribed, much like today's SPACs. Okay, on the first day of trading, shares soared 60%. The investors' mania spurred a rush of brewery IPOs and mergers across the UK and US. An English financier even went so far to trek across the pond to try to buy two of the biggest brewers in Milwaukee, Frederick Pabst and Joseph Schlitz. But that's a story for another day. As for the Guinness IPO, it made Edward Cecil Guinness the richest man in Ireland, who gave much of his money away to charity that helped the homeless and public housing. Now there's a true good Irishman. Ironically, Edward made much of his fortune from the greed and mania brought on within that single day. So, just as one drunkard always rushes for another Guinness at last call, humans will repeatedly leap at the chance to chase higher returns. That is a great story. I like that. For those who don't know, Taylor writes all these. It's not Patrick. And I must say, I enjoyed that one. That's my favorite. If I had to pick one of these market histories to do, that's the one I wanted to do. Thanks a lot, Taylor.
Yeah, it was a good
Speaking
one.
of yeah, it was a good one. Speaking of Taylor, it's time for WTF Clip of the Week. Taylor, why don't you hop on?
Hello.
Hello.
I'm glad you liked it.
Yeah, it was awesome.
I think my favorite was the Hong Kong one, because I went like so deep in that one. It was like I was like writing a movie, because it was my first one. I wanted to do a good job. But that was like, I got into this guy's head and I was like, oh, what's he going to do? It was really cool. But yeah, this one was fun too. And
this one was better because it was about beer. Okay, so WTF Clip of the Week. What do you got for us this week?
Okay, so this week's clip is from CNBC featuring Paul McCulley, who is the former PIMCO chief economist. And if you don't know PIMCO, like I didn't, because I was like, if it's not Tesla, I don't know anything about it. PIMCO is a fixed income investment management firm with around $2 trillion. So this guy was the lead economist on it. And now before we go into this, I just want to say, like, I have a lot of fun putting these together. And, sometimes when I go to share them on like Reddit, Wall Street Bets, people are responding by being like, these are boomer memes.
Oh.
I'm like, I'm 34 and I'm being called a boomer.
Yeah. Well, did you tell them? Now, I know you guys always think that Patrick and I are boomers, and it's always so embarrassing when you guys say that, because we're Gen X. Even though I am bald and old looking, I am a Gen X. Did you tell them that the guys that you're doing it for are Gen X and blame it on them?
Yeah, and they were like, "What's Gen X?" They were like, that old Pepsi commercial. Is that what that is? That Pepsi commercial? And I'm like, I don't know.
Okay.
Anyway, so this movie, it's spliced with this hilarious Andy Samberg movie called Hot Rod. Hope you guys love it.
The president now proposing these tactical stimulus bills, which would seem to make a lot of sense, but it's unclear to me whether they're going to move forward. So where does that leave us, do you think?
What the president's doing is a great deal of noise, and I have to admit that I can't reverse engineer his tactics right now.
Paul, is there a dollar figure that's important to you?
I think big is the right answer, and that's going to happen, and I think that's what the market is anticipating now, and we have a great deal of political noise, but we're going to go big, really big.
That's awesome. That's a really great WTF. I like that one a lot, even though I must admit I have not seen Hot Rod.
That's fair. It's a cast from Andy's from Saturday Night Live. I don't know if you've heard of that. You're probably around when.
Yeah. Listen, Saturday Night Live has been around. It is actually truly not just a Gen X phenomenon. That's a boomers phenomenon.
Kevin was actually around back when Saturday Night Live was funny.
Well done, Kuppy. Well done.
I think they've had 25 consecutive bad years now. I literally can't remember. People always are like, yeah, man, Saturday Night Live, it used to be great in the 70s or the early 80s. Like, I can't remember it ever being funny in my life.
Really? Like, you're not a fan?
I haven't even watched an episode in 10 years.
I think
Kuppy,
it's gotten better, actually.
Who was your favorite character on it? Who was your favorite performer?
Oh, I like Kevin Nealon doing the news. I thought that was great.
Whoa!
But that's like what?
Cool.
That's like 1990 maybe 1987. I don't know.
Actually, my favorite has got to be Mike Myers when he does the hyperactive child tied to the swing. I don't know. Did you ever see that, Kuppy?
Oh yeah.
No, that was before my time.
Yeah, I know. Kuppy seems like an old soul, but he's actually quite young.
Yeah, I'm young.
Yeah.
I don't feel young anymore.
I know. That's what trading in the markets does to you.
Not after the Guinness diet.
Yeah,
that's right. The Guinness diet is awesome. I had no idea, and I'm going to be...
I promise you'll lose 20 pounds and be drunk the entire time.
Yeah. You'll be much like much of Ireland. Okay, anyways, Taylor, thank you very much for joining us, and really appreciate the WTF clip of the week, and also This Week in Trading History.
Great. Well, thanks so much, guys. I'll see you next week.
Okay, Kuppy, it's time for no stupid questions. Only stupid answers is what we joke about. There's been 3 questions that have been picked in advance, and I just want to give a big shout out to all of our listeners that are writing in. Like, I went through to pick the 3 questions, and I was shocked at how many great questions there were in there, and I really appreciate it. And actually, now that I'm saying this, I realize Lena's supposed to get on and help us with this section, right?
That's right. But you gotta put the questions up on the screen. So
That's right. Okay. So Lena's here because Lena's actually in charge. The people that go and ask the questions are actually sending them to Lena, and we pick them from there. And so here we go with the first one. Lena, read it out.
This question is regarding a tweet from Danielle DiMartino Booth. So her tweet was, "This is the most important tweet I'll send this week. The Fed so fears building disinflationary pressures, it's buying all the tips it can get its hands in an attempt to force inflation narrative into investors' psyches. That's fear." And that's capital. So the listener's question is, this sounds important, and DiMartino Booth has gone caps about it, but I don't really understand what's going on here. Is it worth understanding?
Okay. So I had to do this. It's kind of, I feel like maybe this will get me into some trouble, but I was like, I can't resist this one. First of all, Triple D, and that's what she calls herself. I'm not putting words in her mouth. Right?
Never heard that.
Yeah, she calls herself Triple D. She thinks it's a big deal that the Fed is buying all these tips. Now, I won't make you get into any trouble on this, Kuppy, and kind of comment directly, but do you ever put all caps on your tweets?
Never.
No. It's like you're
but
screaming,
also,
right?
my tweets aren't usually I don't usually use all the characters either. It's usually like 4 snarky words, and I get back to something important.
That's right. Okay. So the question is that, yes, Danielle has made this sound important, and it makes it sound like the Fed is going crazy trying to buy tips to make inflation expectations go higher. The reality is that the Fed is on a schedule about how many tips they're going to buy. And that not only are they buying tons of tips, but they are buying even more by a dramatic amount of regular bonds as well. So if you're using that logic that the Fed is trying to buy tips to say that they create inflation, you'd have to say that the fact that the Fed is buying even more nominals means that they're even more inclined to create deflation. Because let's face it, bonds do better in a deflationary environment. So to answer your question, no, I do not think that this is an important deal. I think it's just part of the Fed's stimulating and doing the quantitative easing. Tips are part of the basket, and it's nothing more and nothing less. So don't get too excited about it. It doesn't mean that much. Let's go on to the next one. Lena, read us the next one.
So the second question is, how can the short interest and the short float on GameStop, ticker symbol GME, be so high? I don't just mean the mechanics of short selling or naked short selling either. The trade seems exceptionally crowded on the short side, and when combined with the relative scarcity of shares and the borrow rate, I struggle to see enough upside in the short term to continue justifying what has been admittedly a highly profitable trade for the past few years.
So, Kuppy, I chose this one for you. So first of all, why were there so many shorts? I have my theories, but like maybe you could illuminate us to why you think there was so many shorts in GameStop.
Well, everyone just thought it was Blockbuster, and Blockbuster was a very crowded short with a few crazy squeezes along the way, but it went to zero. And so every time you had a little squeeze to the upside, you just basically lean into it on the short side, and people just overcrowded it.
Okay, so that's the argument. It's Blockbuster, meaning it's an obsolete industry that it will eventually go to zero.
Well, I mean, everyone thinks it's all going to go digital, and I don't know if they're right or not, but that's the prevailing view.
Okay, that's great. And you know what? You actually understand that way better than I do. The one thing I will say is that in general, and I'm not saying about GameStop, but in general, it's important to understand that there's other reasons to short a stock than just because you want betting it's going down. And I just kind of wanted to highlight, I know when I sat on the institutional desk way back when in the 90s, we would have insiders that weren't allowed to sell. They would come to banks, and actually my bank didn't do this because they viewed it as kind of wrong, but other banks did this. And they would go and enter into collar transactions or some sort of option transaction where the founder could, in essence, sell their stock without actually selling it. And
That's dirty.
Yeah, it's dirty, but they did it, and they basically pushed off taxes and they pushed off reporting. And it happened all the time. It was a very popular strategy. And often when you would go to a bank and ask them to do this, they would insist that you lend them the stock. So the founder would take their stock and actually lend it to them, and then buy the swap or whatever it was from the bank. And so that would show up as a short interest, but it wouldn't really be short. It would be a sell from a long. So one of the things that I just like to highlight is that often short interests are not they're not always somebody betting it's going to go down directly, meaning that they could, for example, in Kuppy's argument or example, he talked about the fact that those guys were betting it was going to go down. They would have to buy it back eventually. Well, in the case of my founder, he would actually deliver into it eventually at the end of the swap. So it's not always the same. Or, if there's a large convertible bond, that's another thing to look at. Like Tesla, for example, when the convertibles went into the money, those were all that became short interest because all the bond arbs would be long the convert, short the bond on a 1-for-1 basis. And so even though it looked like a lot of people were betting against Tesla, a lot of it was actually just the bond arb. So that's something to think about. Having said that, I think the Kuppy's probably more right on GameStop that there were legitimate shorts in there, and they thought it was the blockbuster of this generation.
When I was in ICR, which is the big consumer conference each year in February or January in Orlando, I was in the room with the new management team. They had just taken over. And I thought they talked a good game about cost cutting and, fixing working capital issues. They saw a lot of levers to press to create value and, extract capital out of the business and cut costs. And I walked out and said, this is pretty impressive. I'm going to get long. And I did get long. I would say that of the 30 guys in the room with me, 29 of them were short. And they all walked out and they said, wow, this thing's a flaming dumpster. And I'm like, doesn't seem like it's going to flame. It seems like it has one more puff to it. But these guys, I said to them, what if this squeezes? And they're like, if it goes from 4 to 6, we'll just short some more. They're very dismissive of it. And I wonder if they're still so dismissive with it at 12.
Yeah, it could be a Kodak on them, right?
Yeah, I don't know. And I guess in answering the question of the mechanics of short selling, and I don't think this is naked short selling. I don't really believe that exists. I think that's just like a Patrick Burns sort of thing. But you can have more shares short than the float, just the way that one guy buys it and he lends his stock out, and then, someone else buys those and lends it out. I mean, you have this chain of ownership, and you can, in theory, have substantially more shares short than exist until the borrow gets pulled and the whole thing collapses.
Right. Okay, let's go on to the third and final question. Lena?
So the last question for this week is, I've heard people complain that on low float stocks, Sting is one, that rich investors buy after hours and then sell in the morning to drive down the stock and rebuy after they drive it down and then do it all over every day. Is this a real thing?
So, Kuppy, I kind of laughed about this one because they chose Sting, and I actually did not choose Sting. They chose Sting, which is one of your favorite stocks. Or not favorite stocks. It's one of the stocks that you've traded over the years.
Yes. I have no position right now, but yeah.
Okay. So rich investors. So I wouldn't call them rich investors. I call them more shrewd players as opposed to rich investors. And I will tell you that the world has changed in terms of after hours trading. And I don't know how much you've noticed about this, and maybe we could have a little discussion about this, but way back when I first started, when I was a wee lad, and, we wouldn't trade after hours. 4 o'clock would come, it would be over. Nobody would trade a stock again until 9:30 the next morning. Yeah, eventually we traded some futures, but on the whole, nothing happened after hours. Then the Americans started trading a little things after hours, but really the only things that traded was like when there's a big earnings announcement. Now I have found that from 4 to 8 o'clock, there is just shitloads of trading. I'm just shocked. I'm just flabbergasted at what goes on. And I've been involved in a few stocks lately, and I have noticed this phenomenon of them goosing shit around after hours. And I think it is nefarious. And I really do. I think that they go and they find stocks that they think are getting squeezed, and they move them more after hours. And I don't know sorry, go ahead.
No, I've seen this too in these small float names. I mean, that one you had on the screen before with your chart patterns, like these things after hours will trade millions of shares also, and they'll move them around and try to screw the shorts and panic the shorts and stampede them. And they try to set it up for the next day so that they can dump the shares. A lot of times they'll try to push it up when it's really thin, and they'll push it up in the pre-market, and then they'll just dump the whole day the rest of the next day. And I think there's a lot of games being played.
So I 100% agree with you that there's a lot of games. I'm not even sure if they sell it the next day, but I do think that it's easier to move around in the pre-market and the aftermarket. And so they move it around at that to try to establish new prices. So when this listener is asking, are there people that are playing games in the before pre-market and aftermarket? I 100% agree. There are games being played. Whether it's kind of pushing up and then selling the next day, I don't know. But I definitely think that there's some strange and nefarious things happening.
Yeah, absolutely.
Yeah. Okay, Lena.
So if you have any questions for Kevin and Patrick, and sometimes Kuppy, submit your questions to nostupidquestions@markethuddle.com.
And a big thanks to everyone who's writing in. There's lots of great questions, and hopefully we'll get to all of them. Okay. Kuppy, it's time for skin in the game. And I didn't actually tell you how this works. Kuppy's just coming on this blind. For those who don't know, I asked Kuppy to sub in for Patrick, who unfortunately can't be with us. And he was a great sport. And he said, sure, I'll come in. And he says, do I need to know anything? I said, nope, you got to just show up and be yourself. And that's
somehow or another, I'm going to lose a stake at this. I just feel it.
No. We're going to actually bet on Patrick's account. Okay. So anyway, let me explain to you how skin in the game works. Let me just find my notes here, because I do have notes that I write here. Okay. Skin in the game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows. A Duke and Duke, which is $1, a pint of beer, a burger bet, a pitcher, a case of beer, which is a 2-4 in Canada, a bottle of wine, none of this cheap shit that Patrick drinks. It's a $100 limit, though, and finally a steak dinner. Okay. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions. So, Kuppy, what that means is that if, like, I win 5 cases of beer and he wins 3, we don't just net it out as 2. We actually have to give the other guy 5, and the other guy has to get 3, so that there's full beers drunk. Okay. So let me go through last week's bet so you understand what Patrick did. So last week I presented Patrick with the option that it was the December contract in the copper futures, and I said it'll touch 309.10 or 3.0910. And I let Patrick choose which side the bet he would want, but I knew which side he'd choose because he's always so bearish. And he said, no, it won't. And I said, yes, it would. And then here's the chart. And it wasn't looking good for me, Kuppy. I thought I was going to lose. I actually thought Patrick was going to, pull it out of the hat and going to win, especially when Trump went and did his stunt about when he said that there's going to be no negotiation. It caused a lot of sell-off. But guess what happened? Today at 2 o'clock or something, or I can't remember, 1 o'clock, it punched up and it touched that 309.10. Now, Patrick has already sent me a note accusing me of moving the market. He thinks that I can move the copper market, which I can't. But here he is. This is a picture of Patrick after losing his copper bet. He's not very happy. So I'm going to let you have a chance, because since Patrick is not very good at this game, of choosing Patrick's bet. Okay, and so for the next week, here's the bet that I'm presenting to you. Will the euro currency, like the actual currency, tick at a new high for the year during next week? So the previous highs were 1.2011, and you get to choose on Patrick's behalf whether that will be whether it will tick at that new price next week. It has to settle by next Friday.
It has to just one tick, just a knockout.
Just one tick. It's a one touch, like a knockout, and it's by 4 o'clock on Friday when we tape. You can take your time, think about it. There's no.
I don't think it will. No,
okay.
I don't think it will.
But you know what? You're true to Patrick, because Patrick would chose that as well. So that's good. So there we go.
It's probably the bet he would have taken, actually.
Pardon?
It is the bet he would have taken.
Yeah, so you're doing it for him, but you actually agree with him, right?
Yeah.
Okay, well, there we go. So the bet for next week is, will it hit the euro and hit new highs for this move, which is 1.2011. Now, one of the things is, I don't know if we should actually change the wager amount on Patrick's behalf. Although I can tell you that given the choice you've made, I feel like he probably would. Lena, why don't you hop on?
Yeah, Lena, make the bet.
Yeah, actually, that's true. We're going to let Lena decide on the wager size.
Oh, goodness.
Kuppy's chosen the side that he's going. Mm-hmm. Lena chooses what the wager is. So it's a Duke and Duke. Now I get to choose. I will up it to a pint of beer. Do you want to up it from there, Lena?
Oh, I'm just going to keep upping it. Yeah, let's go to a burger bet.
Well, okay. I will up it to a pitcher.
I feel like we've had a few pitchers in our skin in the game, so let's up the stake and go to a case of beer.
I'm gonna
those
pass.
are tall boys. Tall boys too.
Yeah, it's tall. I'm gonna pass there. So that's it. So it's a pitcher of beer. I don't feel that strongly about it. I feel like Patrick is due to win one. Even the stop clock is wrong every now and then. And
You've
you know
won
what?
The past 4.
This is it. I'm not betting against
you.
Patrick here. I'm betting against Kuppy, which I don't feel as good about.
If Patrick loses, then does he get the beer from Kuppy?
No, Kuppy's not going to. No, Kuppy is just a stand-in. It's we're betting on Patrick's behalf. He's left us with the discretionary account.
But does Kuppy get a beer if Patrick wins?
You know what? If Kuppy ever makes it up to Canada, or if we're ever allowed to go to the States,
you guys won't let me in.
Yeah, I know. We're not going to let him in. He's one of those COVID-filled Americans. We don't allow them in.
It's part of the Kuppy Act. I'm not allowed.
Okay. Anyways, listen, that's it for the show. Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. We're there every day. Give Lena a shout out. She gets tired of talking to Patrick, myself, and even Kuppy. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate us on iTunes. It's a dumb game, but it makes a difference in Apple's algorithms, and it helps us out immensely. Kuppy, thank you so much for stepping in. We really appreciate it. Where can they find you?
They can find me at Adventures in Capitalism. Sign up for updates.
It's awesome. And follow him on Twitter. Where are you on Twitter?
Kuppy.
Kuppy. And make sure you sign up for his blog. It's a terrific blog. Lots of great ideas.
Hey, thanks.
Even though he keeps talking about ED-driven trades, which is...
Man, I keep winning. It's like a broken slot machine.
Okay, and for me, you can follow me at Kevin Muir on Twitter, or get my newsletter at themacrotourist.substack.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. So, Kuppy, you thought you were going to leave us here, but you're not. This is the part where the shit really gets stupid. Taylor,
gave me no instructions.
Yeah. Taylor and Lena get on. And first of all, let's get the beer out of the way.
Right.
Lena, I have to give it a really solid rating. And you know what? I'm no means influenced by the fact that this nice kid gave me the beer. So 9-1.
Yeah, you went soft? Oh my
9-1.
gosh. 9-1.
That's strong.
Strong.
That's a.
What about you, Lena?
You must really like this boy.
Yeah. He's a nice kid.
I'm going to go ahead. I'm going to go ahead and give it a solid 8.7.
Nice. Okay.
It was a good beer. It was definitely a good beer.
And we know Kuppy is sipping on his coffee, trying to nurse his hangover. But Taylor, are you drinking with us?
You know what? Last time I drank, I got really weird, and I'm just gonna sit it out. I'm gonna do a La Croix this week.
I'm gonna sit it out. Okay, so Kuppy, usually at this point we talk a little bit about what shows we've watched or anything exciting that's happened in our lives. And since we have you on, we would love to find out what's going on in Miami. I see that you guys are deciding that you're not quite the virus. It's nothing for Miamians to handle. So they're just like going full tilt, like stadium, fill it.
Yeah.
Yeah.
We're going for herd immunity. Yeah.
So are you gonna go watch some football?
Nah, I'm not gonna bother with any of that.
No. So what if
you? Thing.
No, that's not your thing.
I'm not a sports guy.
Yeah, neither am I. Lena's actually the sad thing is that Lena's our biggest sports fan.
It's true.
No, that's so. Oh, it's just. I was just gonna say it's funny. Like my friend is like super into fantasy football and all that stuff, and I'm like, the same enthusiasm and language you're in, like, and memorization. You should just do that with stocks, man. You would kill it. Like, just learn stocks. Like, you can make some money at least.
Yeah.
People
love the football and they love it. Like, I like it too. And, we're Canadian, so I actually really like the hockey, but I got kind of hockeyed out and it just kind of, I don't know. I don't have time. It seems like sports is a big time commitment.
Well, it is. I mean, when I lived on the West Coast, I used to watch football every Sunday.
Because you could do it because it started at noon. Or 9 in the morning.
When I lived in Vancouver, they were kind of, with, Seahawks by association, since they're all both on the West Coast or whatever. And there were a lot of Seahawks fans in Vancouver. And I actually went to go see a Seahawks game when they played the Broncos preseason in Seattle. And I fell in love with it. I had so much fun. It was so great. And now that's when I realized why people are so crazy about football.
Yeah, and
that's how I understood it.
Did you do the thing where they go into the parking lot and like cook the barbecue on the back of their pickup trucks?
Party? No, it wasn't during the playoffs, so it wasn't during.
No, I'm pretty sure that people do that all the time. Like Kuppy,
probably.
You're our American on the podcast. They do that all the time, right?
Yeah, I think so. I mean, I don't think I've been to a sporting game in 10 years. I did some of that tailgating, though, in college. And I remember that part was really fun. And then, you go in and watch the game, and I thought that was pretty pointless.
I've gone to a few American football college football games, and they're crazy. Like, it's like 100,000 people in the stadium. Like, it's nuts.
Our team sucked at Tulane, so there'd be like 25 of us.
Okay, so Kuppy, what have you been watching then? If you're not into sports, do you watch TV? Do you got some good recommendations for us?
I don't even own a TV.
Come on, really?
Wow.
Yeah, I don't own a TV.
No. Wow.
Really
so
don't.
what do you do? Like, so I know you go out for a lot of restaurants. You like
he
like
drinks.
going out for dinner,
I
right?
drink a lot. I go out I work really long hours. I
Yeah?
get done. I go hit the gym or I go for a swim. I eat and I go to bed.
Honestly,
Yeah,
you
I'm not
live a
making that
boring
up.
life. Like, this is not very fun. We need something fun to talk about. You're not
not
giving us
boring.
much to work with.
I was out till 2 last night. You say that's
Okay,
boring.
so that's okay. What were you doing out till 2? Well, give us like your last night out till 2.
I
Because
was
we're not.
Remember it.
I was sampling a bunch of whiskeys,
Yeah.
like a liter of whiskey, and then I thought I was gonna barf, and I made an emergency run to get some pizza, and I kind of fixed the problem. Then I had some more whiskey. and I had a 7:30 call this morning, and I woke up and I just somehow muddled.
Wow.
I like
Oh,
it.
man.
I thought I was gonna barf, so I made an emergency pizza run. I like it. So for
That's a
those
really good solution.
for those who don't know, you live in Miami, right? You live in South Miami, is that correct?
Yeah, I live in South Beach. No, I was at a bar with some friends, and then my wife came join me. We just drank too much, and I'd been drinking since like 5, and I don't know. I don't usually eat pizza, but there's one of those that needed some pizza.
And so, why didn't you tell us? Like, what is Miami like these days? Like, is it dead, or is it basically people are just powering through the virus and they're kind of going on without worrying about it? Like, what's it like?
So it's a bit odd because we have this 11 o'clock curfew, because like the virus is more active at night or something. No, it's pissing me off actually, because like if you don't sit down at a restaurant by 9:30 for dinner, they won't seat you because they get fined if anyone's there after 11. And if you're walking around the street, you get fined.
You're kidding?
Which is also no, it's
Honestly?
true. It's really stupid.
But how does a curfew help with the virus spreading?
I don't know, but it's all science based.
That's great. Like, and they still do like stadiums. They're still filling
Yeah,
stadiums, but it's before 11, so it's
For
all
11,
good.
not a problem.
Wow.
It's all science based. I gotta send you the city put out a list of regulations covering sports. Like it's ridiculous. Especially you're allowed to play team sports right now, but you can't play team sports unless you own the ball. Golf, you're not allowed to touch the flag.
So, Kuppy, this is insane. Like, you're telling me that you have to own your own ball to play team sports? Looks like we've lost Harris, and we're going to have to save that story for another time, maybe a Kuppy's Corner. Thanks for joining us. Hopefully, Patrick will be in with us next week. For all of our Canadian listeners, have a happy Thanksgiving, and thanks for tuning into the Market Huddle.